Okay, let's continue on. Issuing common shares for non-cash assets. So sometimes rather than cash, they'll receive an asset for its shares. The corporation records the assets acquired at the asset's fair market value at the date of the transaction. So again, they give an example. They've received on July 2nd land valued at $105,000 in return for 4,000 common shares. So debit land, credit common shares for the fair market value of the land. Then they go ahead and then show you the updated equity section now as of July 31st. So before there were 30,000 shares issued, now there's 4 more, so there's 34,000 shares. This is the prior balance of 300,000 plus the 105, and the retained earnings is the 65 from before, and July was 82,000 in profit, and there was no dividends, so that's 147. Okay, preferred shares. So they have special rights that give them priority over common shares. The special rights typically include a preference for receiving dividends. That means that if any dividends get paid, the preferred shares get dividends first, and then after that, then common shareholders would get dividends. And for the distribution of assets if the corporation is liquidated. So if the corporation gets liquidated, all creditors get paid first, then preferred shareholders, then common shareholders. Because of these special rights, preferred shares are always listed before common shares in the equity section. Most preferred shares do not have the right to vote. So then they go ahead here, give us another example. August 3rd, Dillon Snowboard issued 5,000 preferred shares, dividend preference, and we'll talk about that in a bit, of $3 per share for a total of 125. So the entry, debit cash, credit preferred shares, 125,000. Again, always make sure to put the details in the explanation down here. Then they give, again, the updated equity section. So here, let me scroll back. Let me see, yes. When it's just the one form of shares, it just gets listed here as common shares, for example. But now, when more than one class of shares have been issued, so now we have preferred shares, the equity section is classified by grouping the share capital counts under the heading Contributed Capital. So contributed capital is the total amount of cash and other assets received by the corporation from its shareholders in exchange for common and or preferred shares. So because we've now brought preferred shares into the mix, it's called contributed capital. Preferred shares get listed first with their details. $3 unlimited shares issued, 5,000 shares issued and outstanding. So this represents this entry here. And then the balance from before from common shares, that just gets carried forward. And there was new profit in August of 156, which gets added to the retained earnings. And there was no dividends. So this section here, the equity section of the balance sheet, like this. Exhibit 1210, summary of rights of preferred and common shares. So that just summarizes what we've looked at, so that's a good thing to read through there. Motivation for preferred shares. Nothing really of great importance here. So one reason for issuing preferred shares is to raise capital without sacrificing control of the corporation, because common shares have voting rights generally. A second reason for issuing preferred shares is to increase the return earned by common shares. That you can work through this example. Here we go. So the term financial leverage, use of preferred shares to increase return to common shareholders, is an example of financial leverage. So it explains it when the dividend rate on preferred shares is less than the rate the corporation earns on the amount invested by preferred shareholders. The effect of issuing preferred shares is to increase or leverage the rate earned by common shareholders. In a nutshell, that means you raise money from issuing preferred shares. You issue that money, you use that and invest it, and you earn money, but the amount that you're paying the shareholders, so say it earns an extra $20,000 in income, but you're only paying out $8,000 to the preferred shareholders, you've earned more on those that money. You've earned more by using that money than what you're actually paying the preferred shareholders. So that excess then goes to the common shareholders. You can hear my candy. Okay. Okay. Yes, that is it for that section. Okay, let's move on to dividends. So dividends are how a corporation distributes its earnings. Dividends cause retained earnings to decrease. So remember before when I was showing you the equity sections, I always, when we looked at retained earnings, I always mentioned there were no dividends. If there were dividends, that would decrease the retained earnings. So let's take a look at dividends, cash dividends. So corporation is permitted to pay cash dividends if there are retained earnings held in the company and cash resources exist to pay shareholders. If there's no retained earnings, you can't pay dividends. The entries for dividends. So first of all, there's 3 dates that we need to know about. So date of declaration, that is the date that the directors vote and declare a dividend. So they decide to pay a dividend, they've created the legal liability. It's not paid at that point in time, but they've created a liability now because they've voted to pay a dividend. So that gets recorded here. To give an example, $1 per share dividend, and there's 5,000 shares, so they're going to pay $5,000. So they credit cash dividends. They debit cash dividends. They credit common dividends payable. So they credit a payable account. Explains here that cash dividends is a temporary account. And it just shows the amount of dividends that were declared in the reporting period. It's not an expense account. You could also just debit retained earnings directly. If not, this will get closed into retained earnings later. So date of declaration is the date that the dividends are declared. Date of record, so that is when they declare the dividends, they'll say all shareholders as of a certain date. So anyone who's a shareholder at that date will receive the dividend. So that means if you buy shares, they could declare a dividend now and say the date of record is next week. If you buy shares now before next week and you're the owner at that particular time next week, you will receive the dividend. If you own the shares at the date of the record, but then you sell it right afterwards, but you are the owner of the date of record, you're the one who receives the dividend. Date of payment is the date when the shareholders receive the dividend, when it's paid out. Oh yeah, so this is important here. At the end of the reporting period, so let's go back up. So the date of payment, we debit the common dividends payable, whereas up here, we created the liability here by crediting that account. We're going to debit the account now, and we're going to credit cash because we're paying out the $5,000 in cash. But we still have that cash dividends here, so we credit that account and we debit retained earnings. The alternative would be to leave cash dividends out altogether and just debit retained earnings right from the beginning. Deficits and cash dividends. So a corporation that has a debit balance and in retained earnings, so retained earnings should normally be a credit. So if it has a debit balance, which is an abnormal balance, it's said to have a deficit. So this comes about when a company has cumulative losses that are greater than the total profits in the prior years. That's here. If you have a deficit, if the corporation has a deficit, they're not allowed to pay dividends. Okay, so let's take a look at some special features of preferred shares. Dividend preference. So that means that common shareholders can't receive dividends unless preferred shareholders get paid their dividends first. Now, see where it is. Oh, here it is. If dividends are not declared on preferred shares, the undeclared dividends from prior periods plus current dividends are paid if the preferred shares are cumulative. So that means in 1 year, there's no dividends declared. So say they're supposed to get, X amount of money on a dividend each year. In 1 year, if it's not declared, in the next year, if they do declare it, they have to go back and pay what was missing from the year before and this year's before they can pay dividends to common shareholders. So, where am I? Here we go. So cumulative preferred shares have a right to be paid both current and all prior dividends before any dividend is paid to common shareholders. Dividends in arrears. Here we go. We want to look at this term. That is the term unpaid dividends are called dividends in arrears. And non-cumulative preferred shares. So that means if no dividend was declared in a particular year for preferred shareholders and they're non-cumulative, they don't get that dividend. It's lost. But they still in future years they still have to pay preferred shareholders their dividend that year before they can pay them to common shareholders, but they don't have to go back and pay them for the missed years. Okay, let's look at this example here. So, during the year ended April 30th, the first year of the corporation's operations, directors declared and paid total cash dividends of $31,400. During the year ended April 30th, 2021 and 2022, total dividends declared and paid were $0 and $110,800 respectively. So we look at two different assumptions, non-cumulative or if the preferred shares are cumulative. So first, if they're non-cumulative, the first year they've declared $31,400. So this is actually stated up there too. So there's 7,000 preferred shares. Where is that? It's here somewhere. Oh, we go up here. 7,000 shares, preferred shares, at $2.20. So that's the dividend that they get to receive. So 7,000 shares, $2.20 per share is $15,400. The remainder of that $31,400, then whatever's left, goes to common shareholders. 2021, there were no dividends declared, so no one gets anything. 2022, they declare $110,800. Preferred shareholders get paid first, but they don't get paid for the missing year. They just get paid for the current year, 7,000 shares at $2.20 a share again. So they get paid, and then whatever's left goes to common shareholders. So preferred shareholders get paid first, but if it's non-cumulative, they don't get paid for the missing year. Whereas here, year 2020, the first year, it's the same. But in year 2021, nothing gets declared. So in 2022, when they declare a dividend, the preferred shareholders have to be paid the $15,400 from 2021 and the $15,400 from 2022 first. Then the remainder goes to common shareholders. So here, the common shareholders receive less than that year. Closing entries for corporations. So what we've looked at before, all temporary accounts get closed to the income summary account. For corporations, there's one more step. The balance in the income summary account then gets closed to retained earnings. So that is debit income summary, credit to retained earnings. And then the final step is to close dividends, so cash dividends, retained earnings. So financial statement analysis, there's two things we can look at, return on equity and book value per share. So return on equity, it helps us to assess how profitable a company is from the financial position of its shareholders. Okay, this is going to end, so I'm going to pick up in the next video.